Good morning, everyone. On behalf of PPS Investments, I'd just like to thank you all for taking the time to join our webinar today. My name is Reza and I look after the distribution team. Now, over the last few weeks, the world has changed so drastically. I mean, I almost think to myself that I'm stuck in a movie somewhere and trying to chase an outbreak monkey. But this new normal and uncharted territory we find ourselves in, we know that there will be difficult times ahead for our clients. And the only thing we can equip ourselves with is information to stay on top of matters and to best help our clients remain calm during this very emotional and draining time. So today we have our CIO, David Crosoer, and two of our portfolio managers, Reza, Hendrickse, and Luigi Marinus, who will be sharing their thoughts on the impact of the virus and what it's caused, and as well as any opportunities that's actually come up during this period now with all the volatility we're experiencing, and also what the future holds. I know they will also definitely touch on the conversations that happened last night, where our president addressed the nation to explain about the 500 billion rand that will be put aside to assist us. But before I hand over to David and the team, I'd just like to please ask that we keep this chat as interactive as possible. On the side, you'll see there's a Q&A section. So please load any questions that you'd like us to address to the team, and I'll make sure that David and the guys actually answer them. So I think the first person up now is Luigi. So over to you, Luigi.
Hello, I don't know if you guys can see. There we go. Thanks for the introduction, Razik. Good morning, everyone. Thank you for joining us this morning on this webinar. As Razik alluded to, we've only prepared a few slides with the hope of making the session as interactive as possible. So please, we want to focus on the questions. So if you have any questions, please make sure that you put it in the Q&A section on the slideshow. Before we look at any charts, I'm sure everyone is aware of the volatility we've experienced in the market as a result of COVID-19 and the various lockdowns across the globe. I've been asked a number of times how this compares to the global financial crisis of 2008. And I think the main difference this time has been the speed of the decline. It's quite evident when we look at the chart. If we look at the slideshow now, the first chart shows the returns of different asset classes since the start of the year. This chart is as up to date as we could have it. It's still Monday. That was the latest that we could update it for the presentation. So we can see that all asset classes have declined, with domestic property, the black line at the bottom, the one that declined the most. It lost almost half its value at one point and it came back. At the moment, it's down about 40% since the beginning of the year. Fortunately, we had adjusted our internal house view to a maximum underweight in domestic properties prior to the crisis at the end of last year. So our funds have had very little exposure to this asset class. We look at the chart again, something quite interesting. If you compare the blue and the grey lines, these are global and domestic equities. The declines have actually been at the same pace and to the same extent if you look at it in local currency terms. So if you look at the global in US dollars and if you look at the local in rands. However, if you look at the purple line, so that's the one at the top, that's global equities in rand. So we can see due to the depreciation of the rand against the dollar, global equities have actually performed reasonably well in rand terms. Kind of in the middle there, you see the green and the orange lines. They show the performance of nominal and inflation-linked bonds. Both have returned to close to the levels that they started the year at. We've been positive about these fixed interest asset classes for quite a while already, and we've been at an overweight in our portfolios for a number of months in both nominal and inflation-linked bonds. Both have had quite a large drawdown. At one point, you can see they almost go down to 80, implying that they were down about 20%, but they've recovered very well, and they're almost at parity now to the start of the year. The pace and volatility of the market movements reminds us of the benefit of a risk-conscious, diversified portfolio. The point is you're either diversified or you're not at the time of going into a crisis. There's no time to make adjustments once the market moves so violently. And as a multi-manager, we make use of diversification both from an asset allocation perspective and from a fund manager perspective. So the question is, how have our funds held up during this difficult period? On the next slide, if we can just move to the next slide, please, Selma. There we go. This shows the absolute performance of each of our funds, as well as the relative quartile performance compared to each category. We've shown quarter one for 2020, as well as year-to-date numbers, 1 year, 3 year, and 5 year returns. The Q1 returns are from the start of the year to the 31st of March, with all other returns until, as I mentioned, till Monday, the 20th of April, which is the latest returns that we had available prior to putting together the presentation. We know that clients will see quarter one returns in the latest statement, so that's why we wanted to show that column, and you can see what some discussions are probably likely to be like with these clients. Unfortunately, there's no hiding away from absolute drawdowns when the markets are this volatile, so you can see some negative returns across the board, especially in the shorter term period. It was a very difficult quarter, and there's drawdowns across almost all categories. However, we believe that our funds have been resilient as the majority have delivered either first or second quartile returns in Q1 and year to date till the 20th of April. And this is repeated in the long-term returns as well. In Q1, you'll see, yes, there were 2 funds with fourth quartile performance, but this was the equity fund, and it's a single asset class fund, and the balance index tracker that has a fixed asset allocation. So there wasn't much opportunity to make any changes to those portfolios. The funds where asset allocation is active have performed well relative to their categories. If you look at the bottom half of the table, we name it partnership funds. There are 4 new funds, namely our defensive fund, stable growth fund, managed funds, and the global equity funds, which are still quite new and have performed particularly well. And I think this shows the risk-conscious investment styles that we share with those managers. Overall, I hope it's evident that our investment process is mindful of the risk being assumed when investment decisions are made. And so for now, I'll leave it at that, and I'll hand over to David, who will look at whether we've seen something like this before and outline the macroeconomic scenario. But remember, I do welcome any questions. So thank you.
Thanks, Luigi, and welcome everybody. The slide I've got here takes a longer term perspective than what Luigi showed. So he looked at about the past 5 years. This goes back to 1960. So we've got about 60 years of data, and it's looking at the domestic equity market, which is the most important asset class for our funds to have exposure to if we want to have inflation beating returns. And I think I want to make 2 main points from the chart. The first is the gray line that's read off the right-hand axis. This gives you a sense of the total return of the SA equity market since 1960, and it starts at a value of 100, and you can see that it's increased to just under 8,000 over the past 60 years. Now we've adjusted this return for inflation, so this just shows the strong compounding effects of having the equity market. Interestingly, over the past 5 years, you can see the line is relatively flat. That just shows the difficult environment we've had over the past 5 years to generating inflation-beating returns. The blue line is read off the left-hand axis, and this gives you a sense of the volatility of equities. So this shows you the price change in any rolling 12-month period of the equity market. And you can see that the price investors are willing to pay for this stream of earnings can vary significantly in any 1 year. The axis goes from minus 60% to 120%. And we just circled in red below times when the market fell by at least 20% over the previous 12 months, which is what's happened in the recent quarter. And you can see there's been 8 or 10 previous opportunities where we've had these sharp falls in the market. Now, typically, buying at down 20% hasn't necessarily been the bottom of the fall. You can see some falls where the rolling 12-month fall was even further, but generally the market's recovered very quickly subsequently. So where we have had sharp falls in this period, it's generally been quite a positive time to buy equities. Selma, if you can just move to the next slide. The challenge, of course, is that maybe this post-war period is not the most applicable period for us to be looking at. So in this chart, we're just showing some iconic pictures from the Great Depression, which is the period that a number of analysts are thinking maybe the world's going into this kind of scenario now. And the post-world period is maybe a bit simplistic. Now, they're thinking this for probably 2 reasons. The first reason is that the change in economic output over the past quarter has been so extreme that we haven't seen a change like this since the Great Depression. Now, the chart on the top right uses the UK as an example, and we show the UK because it's got one of the best longer-term data series, but this is effectively true for almost all countries around the world. And you can see the red line is the forecast that a UK research unit is making for what it thinks is the impact on the UK economy of the current lockdown. And you can see that significant fall in economic output dwarfs anything we would have seen in the post-war period, and even dwarfs the Great Depression. Now, the second reason people are maybe thinking, is this like the Great Depression, is you can see in the past, particularly the post-war period, most economic contractions, there was a relatively rapid recovery. But in the 1920s and 30s, the recovery took a lot longer to take place. So in this particular forecast, those forecasters are seeing quite a rapid rebound in economic recovery. But the critical question around, is this like the Great Depression, will be if the economy doesn't rebound as quickly as people are expecting. And in order to try to get our heads a bit around the pace of the economic recovery, we've constructed another slide, which maybe we can move on to. And this just tries to give a sense of the possible kind of scenarios for the global economy to recover. And many of you may have read about these. They're known as the V-shaped recovery, which talks to a much more rapid recovery in the economy. And that's kind of the scenario the market maybe has been pricing in this month, in April, where we've seen a bit of a bounce in the economy on the back of stimulus. And I hope that the global economy will recover relatively quickly. We constructed these scenarios 3 or 4 weeks ago, and you can see that we gave that a tentative probability of around 25%. So we didn't necessarily think it was likely that the global economy will be able to bounce back very quickly from this. Interestingly, in the kind of forecasts we've seen from the IMF recently, which are forecasting the global economy to contract by about 3% this year, that's probably based on a V-shaped recovery. The U-shaped scenario, which we thought was more likely to take place, is where the economy takes a lot longer to recover and doesn't bounce back as quickly. And here we think emerging markets like South Africa are particularly exposed to this. And in this kind of scenario, we thought this was the most likely scenario. And here, South African GDP growth would be quite adversely affected. We've deliberately left quite big bands around our expectation for economic growth, just to reflect the kind of uncertainty there is. When the South African Reserve Bank last week had their Emergency Monetary Policy Committee, they were forecasting a GDP recovery of around GDP of about -6% for the South African economy, and that's kind of based on a U-shaped recovery. When they were in the Q&A afterwards, they kind of felt they thought it would be a bit of a U-shaped recovery. And then the kind of Great Depression scenario is the L-shaped scenario, where we just get into a very negative scenario. And here we're unable to contain the pandemic. We have repeated shutdowns and lockdowns, and we have a significant contraction in economic growth. We don't think that's the most likely scenario, but clearly that scenario is very negative for the global economy and for asset classes and equities in particular. So we just gave a relatively significant range of the SA equity market in each of these scenarios. I mean, you can see just to reflect the very broad differences around what could happen. Reza is going to talk a bit later to how we try to construct portfolios to manage this kind of uncertainty. But I thought I'd maybe just leave you with the following slide, which just talks to ultimately the trade-off that the world's grappling with at the moment, and the reason why there's so much volatility, and the reason why the world will probably end up being different from any of the scenarios I've just outlined anyway. So on the top left, you can see the extent of the lockdown. This was taken almost a month ago, and if anything, it's got even more pervasive. But you can just see the very significant response to the global economy in terms of trying to flatten the curve. Now, this is a very clumsy response to dealing with the pandemic because it effectively shuts down all economic activity. The OECD, which is the bar charts at the bottom, came out with a forecast on about the 1st of April saying if the world was in lockdown for a whole year, this is the kind of impact you'd have on economic growth. And you can see that for the G20 countries, that economic growth impact ranges from -15% to -20% for the year. South Africa is the ZAF in that chart. I don't know if everybody can see that, but we're relatively better off than a number of economies, but still are going to expect it to contract by about -17%. Now, the reason I said the lockdown is relatively clumsy is the chart on the right, I quite liked. It's from the New York Times. It just talks to the extent in the United States that people stop traveling more than just going to their local grocery store with the lockdown. And you can see that despite the calls for people to stay at home, a lot of people kept traveling for an extended period of time. And even in South Africa, we've received information from Tracker and various car companies that in the last week, South Africans have also been traveling more as they get a bit frustrated with the lockdown. So the reason I'm framing maybe this isn't the worst case scenario or things will change is people will genuinely come forward with more pragmatic ways to dealing with the pandemic than shutting down the lockdown. I've read two interesting studies recently. The one was in the US based on if we were able to test everyone in the population every 2 weeks, we could put almost 80% of the population back to work because we would be able to isolate quite quickly people who were infected. And even if the tests weren't so reliable, this would have a lot less of an impact on economic growth. And then there's also been a study recently, an Israeli study, that talks about because in the first 4 days of infection, people aren't expected to be infectious. You could set up the economy to do on 14-day cycles where people come to work for 4 days and then self-isolate at home for 10 days and then come back to work. And again, the economic effect won't be so dramatic. So I suppose what I'm trying to leave us with a bit is we've had a very clumsy response to dealing with the pandemic, but undoubtedly we are going to get more adept at trying to figure out ways to get the economy to restart and to be able to try to get some sense of normality so we can avoid these very significant falls in GDP which will occur should we keep such a strong lockdown response to the economy. And I know the president on Thursday is going to come out with some kind of announcement about how we're hoping to set the South African economy back on working. And hopefully over the next year, we'll get more and more instances of us being able to restore economic growth. So although the negative scenario of a Great Depression scenario is quite frightening, there is some grounds for optimism that we might be able to restart the economy to some extent going forward. And with that, I'll hand over to Reza, who will be able to give you a sense of how we apply this thinking to the actual portfolio process.
Hi, good morning all. My name is Reza and I'll be talking a bit about asset allocation and positioning before summarizing and then opening the floor to questions at the end. So this table shows our house view over evolution over the past 2 years or so. And in general, our style when it comes to asset class tilts is to be less active rather than more. But having said that, the backdrop lately has presented more opportunities than usual, and we've therefore acted accordingly in a sort of a measured way. Under normal conditions, though, we do try to be less active and really only aim to get the big calls right. We also have strict bands in which we operate, and so we tend to move quite carefully and incrementally. So the table shows the main asset classes down the left and the calendar quarters across the top. And we've color-coded the changes. Now there's actually a lot that goes on behind the scenes, and the process is actually quite scientific, but this is just a summary slide. And so to give you some color, our view on each asset class is arrived at by looking at 3 distinct areas, being valuations, the macroeconomic backdrop, and momentum. When it comes to valuations, we look at each asset class independently in relation to its own long-term history, because as you know, starting valuations are a key determinant of future returns. Secondly, we consider the macro drivers of each asset class, such as equities. In the case of equities, we look at economic growth, etc. In the case of bonds, we consider interest rates and inflation. And these long-term cyclical forces help us to understand whether there are tailwinds or headwinds at play. And then lastly, we also consider price action, which is an objective way of looking at the world and forces us to ask ourselves, what is it that the market is telling us? and trends obviously tend to persist, and nowhere is that more obvious than in real-time data. The bottom line to emphasize is that in this framework, we consider asset classes both in their own right as well as alongside each other by considering their relative attractiveness. And that's quite relevant in a portfolio context where buying something typically involves selling something else, and so that relative trade-off is quite important. But at the end of the day, our investment process allows us to hold different asset classes depending on the objectives of the underlying portfolios. And so what have we done? And coming back to the slide in front of you, as you can see, we've maintained our overweight in foreign equities, and that's the middle band in the middle of your screen. At the same time, we've increased the exposure to South African fixed interest in recent quarters, but I'll talk more to bonds on the next slide. And we've also reduced exposure to South African growth asset classes, as you can see, in light of the very difficult macroeconomic environment we face locally, despite valuations having improved more recently. Although local equities should do well in a V-shaped recovery, this is certainly in our base case assumption, as David outlined earlier. South African equity is far less resilient compared to offshore equity, and we continue to prefer offshore over local. It's important to emphasize, though, that given improved valuations across most asset classes, we don't require disproportionate allocation to South African equities to achieve our return objectives, and that's critical in understanding where we're coming from. South African bonds, for example, are offering returns far in excess of inflation. And then lastly, on a total equity basis, we are still neutral on total equity, but do hold more global and less local compared to strategic. And so turning to the next slide. This chart illustrates why we think South African bonds are compelling. It's a busy slide, but I'll take you through it. The combined bars show us the yields on offer for nominal bonds, ranging all the way from 1-year maturity across to 15 years on the far right. It's upward sloping, as you would expect, with longer dated bonds offering additional compensation for their term. And we've got a bit further and separated each bar into an inflation component and a real yield component, where the grey bars indicate the market's view of inflation, and that's simply the so-called break-even rate between nominal and real bonds of various maturities. So for example, for the next year, the market thinks CPI will be 3.6%, while over the next 15 years on the far right, the market thinks CPI will be 8.3%. And then the reddish-brown bars on top of that are really the return above inflation across the spectrum. So to drive the point home, if I hold a 15-year South African nominal bond, the return I'll get is 8.3% compensation for expected inflation, plus an additional 4.2% return, which is around 12%, and we think that's very attractive. If inflation indeed turns out to be 8.3% for the next 15 years, and we hold this bond to maturity, we'll therefore get a 4.2% real return. But if inflation is less than the 8.3, our real return from holding this nominal bond will be even higher. The challenge is, though, we don't know what inflation will be over the next 15 years. It could be far higher than expected, for example, given South Africa's weak fiscal position. So what one could do is buy an inflation-linked bond today and hold it to maturity, and we can essentially lock in that 4.2% real return regardless of what South African inflation does. And that is also quite attractive. So with all of this in mind, we've therefore been allocating to local bonds across the portfolios. The interesting thing is that although this chart is updated to last Friday, at the time when we moved to a maximum overweight equity bond position, we could actually secure 6% real return on inflation-linked bonds at the time, which is roughly what one expects from equities over the long term. So that's bonds, but what about cash? And cash is shown on the far left of the chart. Those are the two bars, and these are essentially the overnight and 1 month rates that you'd get from leaving your money in the bank, either overnight or on a 1 month deposit. So there is some credit risk here, but what you see is that you end up with far less compensation above inflation, about 1% if left overnight and slightly more on a 1 month deposit. But what are the risks to this real return? Inflation is a risk, firstly, which could be higher than 3.6% over the next year, but this looks unlikely in the short term given the economic environment. Another risk, of course, is that the SARB could cut interest rates. We've already seen 2 and a bit accommodation this year, and we expect more to come. So staying in cash appears attractive in the short term, but it's unlikely to be prudent in the medium term. And so hence it's critical that we keep investors committed through this short-term volatility, because valuations outside of cash are now offering considerable compensation. So turning now to the last slide and to sum up before we tackle questions. It goes without saying that there's a great deal of uncertainty out there at the moment, and markets don't like uncertainty, which is why we're seeing these wild swings in asset prices. We've also never been in a situation quite like this before in our lifetimes, so it's understandable that we are seeing this. But the next few months will be challenging for investors. Markets are likely to remain volatile while they try and price in this relative trade-off that authorities will be forced to make in terms of keeping the economy alive and saving lives on the other hand. At the same time, though, the recent market volatility is creating new opportunities for investors to benefit from going forward. For now, all we're doing is sticking to our disciplined and diversified multi-manager process that strives to take appropriate levels of risk to achieve our return objectives and also to adequately protect capital. So in closing, this will pass. It's easy to flee to the apparent safety of cash in times like these, but this is seldom in the long-term benefit of investors. In all our portfolios, we are mindful of the need to strike that appropriate balance between participating enough should the world turn out to be better than expected, but also staying sensibly diversified should there be further periods of market weakness. And I think I'll leave it there, Reza, and hand over to you to moderate the interactive portion of the webinar. And once again, thanks very much to you all for joining us.
Thanks so much, Reza. Appreciate it. Glad you guys managed to talk nicely about those slides. I was actually very tempted to interrupt you guys. We have so many questions coming from the audience. The first one I'm just going to publish here on the side so that everybody can actually see it afterwards as well. This one I'm directing at David. So Steph Mangre asks, how do you guys foresee the next 3 months in SA to affect the financial markets and the 500 billion that's going to be pushed for economic development? Also considering the president's deploy SANDF to be announced till the 26th of June 2020. Just publishing that as well. David, would you like to give us some comments on the question from Steph?
Thanks, Razek, and thanks for the question. So the president obviously spoke last night, and there's still a lot of details that are not entirely clear in terms of how the 500 billion rand is going to be funded and going to be rolled out. So it's clearly positive in the sense of we've committed to a substantial support framework. It's about 10% of our GDP. We didn't think South Africa would easily be able to afford a kind of 10% of GDP package. That's sort of equivalent to what developed countries have done, but a lot more than most emerging markets have been able to do. The big challenge for South Africa is the rate that we have to fund that kind of expenditure is a lot higher than a developed economy. But it does seem like the government is trying to fund this not by coming to our local bond market, but restructuring some of the budget and going to the IMF and World Bank and BRICS Bank for funding. I'm hoping that just like Ramaphosa in the early 90s was able to be the statesman that delivered us our constitution, he's through some strange and almost wonderful couple of decades of process been placed in a similar environment now to be the statesman that rebuilds our social compact. So it's always difficult to know the balance of power in the ANC and the politics, but the positive of this is that, you know, now that we've been able to come up with a meaningful social security package, Tito Mboweni will be able to come out with a restructuring of the state-owned enterprises and a business-friendly economic package. It looks very challenging for us to fund the increase in these social grants past the next 6 months. So we really do need our economy to pick up in order for us to make this sustainable. So to Reza's point, as a multi-manager, we will always try to diversify our portfolios and not overexpose them to a particular view. But there is a scenario where South Africa is able to land something here that could be quite important for us going forward. Of course, this detracts nothing from the fact that we're in a very challenging space, and a 10% fiscal stimulus package, if our economy is contracting 10%, basically leaves us where we were before the contraction. So it's not going to be an easy time for us. But there are early signs, possibly, that this is maybe something quite profound. But as I said, it's very early days, and we're going to need to follow this with interest.
Thanks so much, David. Just another one I see here from Andre beside note that he's addressing to you, actually. So his question here says, David, do you have any insights which sectors will come back into reduction?
There have been various draft things circulating around that no one's quite sure what they. Yeah, so I've seen some stuff, but I've got nothing definite to go on. And I think we're going to hear an announcement in the next couple of days. But presumably the government's trying to look at this quite pragmatically, and sectors that are seen as relatively low risk or sectors that are seen as quite critical, I think will be prioritized. But we haven't seen anything definite yet, and I think that's something that we're all looking quite closely at. Certainly there's been anecdotal evidence, but there's nothing that I can say with definite at the moment.
Thanks, David. I see the next question I think would probably be best suited for Luigi. This one I'll publish from Russell. Luigi, tell me, what's the probability of SARB cutting interest rates to zero, like to the extent the US Fed has done?
Thanks, Razik. I think the big difference between South Africa and where we at and the US is the starting point. We have our inflation is quite low now by our historical levels, but it's still higher than we see in the developed world. And also our government has been quite hawkish, so they've been careful to keep interest rates at a certain level. The probability of going to zero, I think, is quite low. What we do want from the market, from our short-term interest rates, is that it's helpful if it's above inflation. And so to reduce it to zero will imply that we're going to go quite a long way below inflation. So I see that as quite unlikely to occur. As we've seen already, I mean, our inflation level is quite low. So with interest rates having come down so much, we're just slightly above the inflation at the moment, or what we expect inflation to be going forward. Technically, the repo rate is actually a little bit below inflation at the moment. So I'd say yes, we are seeing the probability of, or at the moment, it looks like 75 basis points further rate cuts in this year. That's what the market is generally pricing in. But to go from 4.25 to zero seems unlikely at this point.
Thanks so much, Luigi. I see that we have another question here. We just want to make sure I have the right one here set up. So it was, just take a look here, apologies guys. This one was from Kurt, and he wants to know what is the reason for the JSE sideways or flat performance for the past 5 years. Which one of you guys would like to grab that? Reza?
Yeah, sure. Thanks, Rosie. Yes, so quite rightly so, the market has definitely tracked sideways over the past few years, and that's not necessarily, there's a couple of things that drive market prices. The first one is earnings growth, and the second one is re-rating or a change in the price earnings multiple. So on the earnings growth front, the market has actually seen rising earnings over the past 5 years, believe it or not, especially coming from resources counters more recently. And so what that means is that the PE multiple has obviously had to have come down over time in order for the market to have stayed flat. And that really just means that that stocks have cheapened, not because earnings have come down, but really because market participants have attached a lower multiple to those earnings, just based purely on the fact that they don't see a very high likelihood of earnings sort of rising going forward, which of course, as the earnings profile shows, hasn't been the right call. So I mean, that's basically the reason why the market is tracked sideways. Will it continue to do so? It's difficult to say. I think our view certainly is that South Africa still is in a tough spot. It's in a difficult sort of position, especially for those stocks that are geared towards the local economy. Obviously, those geared more to offshore opportunities are better placed, and so it's quite likely that we see SA equities continue to sort of not really make any major progress, and that we continue to sort of trade in that volatile and very wide sort of trading range that we've seen.
Thank you so much, Reza. I see we have a few questions here on Sasol in particular. I'm just publishing this one quickly. It says it's by Craig Whitby. Morning, guys. Your comments on buying Sasol. And there's another one, opinion on stocks that has to do with oil, with current oil price and levels in mind. So that's from Anonymous. Reza, would you mind taking that one as well?
Sure. So Sasol, we don't have a view on. We don't really analyze stocks, but obviously I can share some general thoughts there, and then the managers themselves have views on these stocks as well. Is it cheap? Value managers will say yes, but there are challenges there, as you know, and that was even before the oil price collapsed in Sasol's case. And so when it comes to Sasol, Lake Charles, which is that major project that they've taken on in Louisiana, was really just starting to come online. The market was starting to become optimistic on it, but then all of a sudden the oil price collapsed when you had the Russia and Saudi OPEC fallout, where Saudi ended up flooding the market, and really at the same time we've had a demand collapse, and so those two things have collided, and really it has sent the market into a bit of a panic situation. Oil futures the other day traded in negative territory for the first time ever, and so what that means is that you were being paid $20 odd a barrel, whatever the oil price was, to take delivery of oil. And so there are some complexities in that market. It is a physically traded market, and so given that storage all over the world, tankers, everything is full to capacity. Nobody can take delivery of oil, and that's really what drove the dynamics in the oil futures market. But in short, Sasol does probably have some skewed upside. You could argue from here the price was north of 300. It's now closer to 30, or I'm not sure what it is today. But that risk of a rights issue obviously is still there, and so and then obviously we've got the fact that one doesn't really know when demand is going to come through again. And so certainly, as I mentioned, the managers do see certain managers do see some value in Sasol as well as other oil counters, but I would say that's really the full extent of going to comment, I think.
Thanks so much, Reza. Appreciate that. I just want to, so as our attendees registered, some of the guys actually posed questions as well when they registered, and I just want to throw one of those at Luigi. This particular question comes from Oliver Balcom, and he asks, any stance on listed property in general? I see we have an anonymous comment as well, also just referring to SA property market and recovery. So Luigi, would you mind taking us through what your stance in the property space right now? Sure,
thank you, Rosie. I'll first start by saying, remember the slide I put up, as property is currently down 40%, domestic property year to date, and then highlight what Reza's chart that did in terms of our house view allocation, and we maintain our maximum underweight in domestic properties, and that's a view that we got into last year already. The economic situation in South Africa has been quite difficult for the property market, and we've seen some companies come under difficulty with going into a recession like we did prior to COVID-19 already, and making rental payments quite difficult in that regard. So we thought that it would be difficult for the property market. I saw also, as I was going through some of the questions, it was a good question and something that we're also looking at in terms of now that we've had the lockdown and people working from home, what does that mean for the property market? And I think about ourselves and how we've been able to use the new technology and been able to have webinars and interactions with the rest of our teams, and it's actually been quite seamless. So that's also another question that might be difficult for the property market. We have a situation now where, say, for 100 people working at a company, we have 100 desks. We might go forward, have 100 people working at a company and only have 80 desks because some people are more flexible or working at different times and being able to work better at home. So there are some difficulties in that regard. On the other hand, property is divided in different sectors as well. And so we're only talking generally, people are thinking about office type of property. But we also have logistic type of property and residential property. And so we need to think of those differences as well. From a logistics perspective, for example, if you look at Amazon across the world, they've employed more than 100,000 people because of online purchases and so forth. And so they've increased the number of warehouses that they have, the rental in those type of places where they need to be closer to the client so they can have the transportation of goods being easier as well. So it's a very difficult question to just plainly say that in one aspect property will be negative. A lot of that's also in the price. So we have to see how that plays out going forward. Maybe there's the last thing about property. In South Africa, we've had a very much a yield basis when we look at property. So the question has always been like, what yield do we get from property? Globally, that's not really the case. Globally, people look at what's the total return we can get from property. And I think there needs to be a bit of a change in mindset also in the South African market. Because the sustainability of yields that we've seen over the last 10 or 15 years in property, it seems like those level of yields are going to be difficult to maintain, judging from the way that the direction of rental increases in our market. And so investors, I think first need to live through that change in mindset before we'll see a proper reset in the property market and allowance for that to change as well. So I hope that answers the question there, Reza.
Thanks so much, Luigi. While I have you here, I'm just looking at another one from that list. This one comes from Jakub Prinsloo. And knowing the changes made in the portfolios, I know you're going to love this question. Why should I invest in local equity if I can get real returns in bonds? I see we have an income fund more risky in the next few years. We're suspecting any chances of default of these funds as well. So if you could potentially address these two at once, thanks. Okay,
thank you. I mean, the first question that you asked, I mean, talks exactly to the way that we're looking at the market now. And so we, as from what Reza has said, you could see that we have been more positive on bonds, both nominal and inflation-linked bonds at the moment, as opposed to domestic equities. And I'm sure there's a lot of information out there implying or talking about the low valuations in domestic equities and those opportunities. The difficulty with that, and we do believe that is true, there's still a lot of uncertainty in the market, and so we're taking a bit of a conservative approach in terms of domestic equities at the moment. We're saying that if you can get 12% with nominal bonds for 15 years, over 15 years per annum on average, that's quite a good return. It's going to have to be quite a good scenario for equities to deliver a 12% return per annum for 15 years. And I'm not saying that equities cannot reach that level, just the probability of declines during that time, the uncertainty that goes with compared to what we can get from the bond market, really makes us hold more bonds in our portfolios. There's very little certainty in the market at the moment, and where we can get some of that, we are introducing that to a larger extent in our portfolios. So we're not saying that bonds are going to deliver an even 12% every year for the next 15 years. On average it will, but it will still be a bit of a bumpy ride to get there. So we still live with a bit of that volatility. And maybe the second part of your question where you referred to defaults. So that is definitely a concern. For the most part, the managers that we are investing with are conservative in the issuers that they are selecting. So to a large extent has been government bonds. They've been very careful about corporates. So when we look at ratings of these corporates, the rating levels are quite high. We're trying to stick to A and A plus issuances. Our corporate bond exposure, where the risk of default, where there might be a risk of default, is quite low in our portfolios. So that does point to the fact that we are concerned. If some companies are struggling to be profitable, to be in business, there might be some questions around their ability to pay their debt. So we've been very cautious in that regard. What we know from the South African government, though, is that they can print money. And you can see the government is also making a point of getting money into the economy. That has been echoed from the Treasury and from the South African Reserve Bank as well. So we have no concerns about default from a South African government perspective.
Brilliant. Thanks so much, Luigi.
Razek, do you mind if I just add one comment quickly? Just on the equity side. To Luigi's point, though, we would never not hold South African equities. So we can think of scenarios where South African equities will do well. For example, if China leads the global economy out of the recession, and we have managers in our equity fund who are positioned very well for that. So not taking away anything that Luigi said about we favor bonds over equities, we will have equities in our portfolios. And I think for any client, we'd want to convey that message to. Don't take any extreme position in any asset class because you don't know what the future will hold. So make sure you have enough exposure across a diversified portfolio to be able to produce reasonable returns no matter what the scenario.
Thanks so much, David. And seeing that you are right there, I think the next one can fall in your lap. How optimistic are we in terms of being able to pay back the IMF?
We don't yet know exactly if we have borrowed from the IMF, but the loan that they're making available is going to be on very reasonable terms, and I don't think will come with conditionality. So it's not going to cause us to need to go through a structural adjustment program. And I mean, it could be it's only going to be on a very low interest rate, although it will probably be a dollar-based interest rate. So I think we should assume that we will be able to pay it back. I think about 80 or 90 emerging economies are borrowing from the IMF or wanting to. So we're not alone here. Often when you do a structural adjustment program and you're one country that's exposed, there's a lot more pressure on you to pay back because everyone else is a good creditor. But if 80 or 90% of emerging markets are all simultaneously borrowing from the IMF, and all of us in the future have a difficulty paying the IMF back, they're going to need to solve a problem for everybody. So I think we're in good company here to be able to borrow from the IMF along with a whole lot of other economies and have a collective response. I mean, it's a bit like the question of if you borrow from the bank and you can't pay them back, you'd much rather have borrowed a lot than a little because they'll need to make a plan if you borrowed a lot. So everyone's in this together, and that should give us some comfort, I think, as to the solution.
Thanks so much, David. I've got another question here. Sorry, guys, there are so many. I think we can throw this one on Luigi, Reza's lap. With the increased number of companies announcing delaying their dividends payouts to shareholders, what impact do you see this to hold for future earnings in equity shares or attractiveness?
Thanks, Rosie. I think that is definitely so. Firstly, it's definitely most relevant, I would say, and most topical in the banking space, where the regulators ask banking stocks to banks rather to kind of hold off on those dividends just to shore up the balance sheet and make sure that they are sufficiently enough capitalized. And so really postponing the dividend, it just means that it will come at a future date rather than right now. And so that's quite different from let's say the property space where they have been cutting those distributions. And so we do think that in the context of banks, let's say that it is a temporary phenomenon. We have seen some support, and we saw last night we heard from the president that certainly there is some relief coming, and there's going to be support for those corporates that have been under strain. But we do think that this is in the bank certainly that it is a temporary phenomenon.
Thanks so much. I see here's another question while I have you there from Isak Sadler. What is the maximum downturn expected for equities in your mind?
Yeah, so that's a difficult one. I think we can the chart which David showed earlier, which showed the rolling 12-month percentage change in the JSE, that gives us quite a good good sense, it shows that we are already quite a long way into this sell-off potentially, but that there might still be some further pain to come. The equity market was down, I think, north of 20% in the first quarter, and so it's quite possible that the market either bounces or goes down further. I mean, I think it's quite binary at this stage. I think there's an equal chance of it going up or down. But I would say that that the chance of further weakness remains quite high. Obviously, this is a live case, and I think the announcement last night was quite surprising. Just the extent to which the government was able to step in and support. But in terms of the extent and duration, I don't think we can really put a number on it. And then just speaking to David's point, we'd rather kind of position for the possibility of both rather than placing bets in on any one particular outcome, if I could put it that way.
Thank you, Reza. I see here's another one from Russell, just while we're talking about equities in particular. Any comments on resources such as gold and platinum? Yes, sure. So we don't invest into specific sectors, but certainly the managers do take a view on those sectors. I think when it comes to resources, those companies and that sector has sort of been a beneficiary over recent months and years. The resource prices have gone up, and what's also been helpful is that the rand has weakened, which is also positive for those companies because resources are priced in dollars, and so when they convert those earnings into rands, obviously it's quite attractive. And so when it comes to precious metals, certain of our managers have been very bullish on that. Those precious platinum specifically, the dynamics in the platinum and palladium markets have been quite supportive. Supply is very tight, and demand is held up, and has actually increased because if you look at vehicle production and those emission standards that have become a lot stricter, the demand for platinum and precious metals has sort of gone up. And so platinum is a very specific case, I would say, and that's really what has driven the resource market and what has caused those share prices to go up quite significantly. In the case of gold, gold is an interesting one. The actual commodity itself, at times it behaves like a financial asset, at times it behaves like a commodity. And so at the moment, probably it's those financial asset demands that is what's driving the gold price. Especially so against the backdrop of sort of most economies globally coming through this monetary accommodation, debasing the currencies. And so people are finding these sort of real assets like gold that can hold their value and maybe even go up compared to, let's say, dollars or dollars, which might in future lose their value. People have kind of gravitated more towards these real assets and precious metals like gold that one would hope would hold its value over time and maybe even increase in value. And so gold as a currency alternative, there has been some appeal on that front. And also, once again, it benefits from the rand having weakened, and we do think that the rand that weakening path in the rand is quite likely to persist, notwithstanding perhaps some short-term strength. And so, so I've spoken. Thanks so much, Reza.
Okay.
Now I'm sorry, you were breaking up a little bit there on that side, okay. So I just wanted to make 100% sure. You can continue and finalize
okay.
If you.
No, it was really, and so resources is likely to still continue to be a strong part of the market, but those stocks, as I mentioned earlier, geared to the domestic economy, so banks, etc., retailers might still continue to feel some pressure. Industrials, on the other hand, I think Naspers falls into that camp. That part of the market is likely to still be fairly resilient given its large proportion of offshore earnings.
Great, so thanks so much, Reza. I have another question here for David. David, will the US quantitative easing introduced a few weeks ago, will it have a similar effect on global markets as it did in post-2008? I see that one is from Marinus.
So it's already had an effect in April with quite a strong recovery in financial markets, and the US has intervened quite strongly. So whether it's going to have a more profound effect on the real economy is kind of more of the debate. So for Reza's comment with physical commodities like oil, where the Fed isn't intervening, we've seen those prices collapse because of the lack of demand. Although on the financial side, it's definitely been able to buttress up the assets. So I think that answer is much more linked to how do we contain the pandemic and how do we get the economy back working than say what the Fed can do. So we've definitely seen the money that's been thrown at the problem as helping financial assets this month, but it's very early days to know whether the pandemic will be contained and economic growth can recover, which is more the profound question. But you know, we're a multi-manager. We're getting quite a lot of questions on specific asset classes, and so what we try to do is to find managers that think differently about the world and then combine them sensibly in the portfolios. So we'll tend to have managers that are thinking differently, so that we get a more diversified exposure. And I think we haven't really commented a lot on our managers through this recent period, but they've tended to do relatively well in this period, which has helped the portfolio. And they're not all going to get things right individually, but if we can combine them sensibly, we can hopefully give an outcome to our members and clients which is more robust. And that's really the focus that this team has in terms of how we're positioning the portfolios, to understand the manager's own strategies and that they're thinking sensibly through this very uncertain time.
Definitely. Thanks so much, David. I see one of the questions I'd definitely like us to touch on as well is, all things being equal, where we just to find it. Okay, yeah. How do you all see the exchange rate performing in the short, medium, and long term? Is junk priced in as many commentators thought? And also, if you can give your foresights for the rand. I know we only have 2 minutes left in our session, so if you guys can make a couple of closing comments as well on those before we exit.
I'm happy to tackle that one. Somewhere we've got a chart on the rand right at the end of the presentation. If you like, we can show that. But essentially, so the rand has weakened quite significantly lately. And what we can see, so there's a chart of the rand over the long term, and we can see that it's weaker than ever. The chart at the bottom just shows the deviation from its 200-day moving average, and it just shows the extent of that sell-off that we've seen, which has been a couple of standard deviations away from the normal difference. And so, although we think that weakening path over the long term is likely to continue, and so medium to long term, we still think the rand will continue to weaken, but in the short term, it wouldn't surprise us to see the rand strengthen a little bit before it continues on that weakening bias. And so what's driving that is really that inflation differential between us and the US. And so given that inflation is where it is here, there's a kind of structural bias toward weakness for the rand over the long term. So that's a long and short term view. What was the other part of the question, Razik? I think he's on mute there.
There we go. That would be better. Eh? It was the exchange rate and the view on the rand.
Okay. Yes. So I think I've covered it. I hope I've covered it. If I haven't, please do send the question afterwards.
David, Luigi, thanks so much, Reza. David, Luigi, do you want any closing comments before we log off? We have about 60 seconds left.
Maybe just
sure.
to thank everybody for the time and listening to the presentation. And please, if we haven't answered your questions, we'll get back to them later. And just to let you know that we're trying our best in this period to manage the money sensibly on your behalf, and we've got a consistent investment process that we can rely on in order to manage the risks in the portfolio. Yeah, and Luigi, maybe you have something to add too.
No, I was going to echo the same things, just mainly to say thank you everybody for joining in the webinar. Thanks for the questions. I mean, we were hoping that it was going to be interactive, and I think it was interactive. We got more questions than I thought we thought we were going to get. So we're sorry if we couldn't answer everything, but maybe we can chat about it at some other point as well.
Thanks so much, Luigi. On behalf of everybody on the panel here, I'd just like to say thanks for the attendance once again. we still have, I think, approximately almost 30 questions that we hadn't gotten around to answering, and the overwhelming response has been brilliant. What we will actually do is make sure that we do list all of the questions that we have set up here on the Q&A side that we haven't got to, and we actually get those responses, and it will be emailed out along with the presentation, along with the slides that you've seen currently. And lastly, we will be doing more of these type of webinars to kind of help keep everybody informed and make sure you guys have the knowledge and understanding and answers to the questions your clients might be asking you right now. So lastly, I'd just like to wrap it up by saying thanks once again on behalf of PPS Investments and the investment team that we have here. We really enjoyed the interaction you guys have had and the interest you showed and the questions you asked. And we look forward to seeing you all once again at the next webinar that we manage from our side. So thanks so much in closing, and we'll see you guys soon.
Thanks, everyone.
Thanks.
Thank you. Bye-bye.